Here in Australia, there are addicts, gambling addicts who will literally wear a nappy or a diaper when they sit at their slot machine so that they don't lose their position. This is the kind of obsessive, compulsive behavior that defies logic to all reasonable, logical people. Tesla is such a volatile stock that, well, it makes sense and could be very tempting for people to believe, people who think they're smarter than they actually are, that they might be able to tell when an up or a down is coming on a daily basis. But for most of these people, at the end of the day, all they have to show for this so-called intelligence is an empty wallet and an empty bank account and a lot of false promises. Now, in my view, David Einhorn right now is gambling primarily with other people's money. There's a new sucker born every minute, and this video is a warning to not become one of them. I have to say, people like David Einhorn really make the world a more fun and entertaining place to live in. Watching this guy pour his money down the drain, shorting Tesla stock, is honestly, I find it entertaining. And now he's at it again, even after massive losses in 2020. Now, who is David Einhorn? Why is he doing this? And why does the guy think he's some sort of genius who can outsmart everyone when that's not working so well for him at the moment? Hello, my friends. Welcome to the Electric Viking. My name is Sam Evans. I'm coming to you from Melbourne, Australia. Welcome to all the new subscribers. Welcome back to everyone else. Thank you to our Patreon supporters. I'll put our Patreon link in the description below. David Einhorn, born November the 20th, 1968, is an American investor and hedge fund manager. He's the founder and president of Greenlight Capital, a long, short, value-oriented hedge fund. He was born in New Jersey and he graduated from Cornell University before starting Greenlight Capital in 1996. Over the next decade, the fund experienced annualized returns of 26%, far better than the market. Greenlight Capital's assets under management decreased from approximately $12 billion in 2014 to $5.5 billion, as reported in July 2018. So over the course of 4 years, funds under management decreased by $6.5 billion. Why did that happen? Well, the fund was down 11.3% from 2014 through to the end of 2017 and a further minus 34% in 2018. So what happened? Why did Einhorn do so well when he first started the fund and then so poorly in the 2010s? Now, interestingly, Einhorn was actually included in Time magazine's list of the 100 most influential people in the world in 2013. Einhorn was actually born to a Jewish family in New Jersey, the son of Stephen and Nancy Einhorn. He was raised in Demarest, New Jersey, and at 7, he and his family moved to Wisconsin. His father is the founder and the president of Einhorn and Associates, a consulting firm, and Capital Midwest Fund, a venture capital fund. So that's kind of how he got his start, through his dad. He has one brother, Daniel, who works with his father. In 1987, Einhorn graduated from Nicollet High School in Glendale, Wisconsin, and he graduated from Cornell University with a BA in government from the College of Arts and Sciences in 1991. He was a member of the Sigma Alpha Epsilon fraternity at Cornell. He started Greenlight Capital in May of 1996 with $900,000 in startup capital. Where he got it from? I don't exactly know. In May 2002, he gave a speech at the Sohn Investment Research Conference where he recommended shorting a mid-cap financial company called Allied Capital, eventually disclosing that he himself had a substantial short position. Clearly, he was trying to influence the market from his early days. Einhorn actually alleged that the company defrauded the Small Business Administration, while Allied said that Einhorn was engaging in market manipulation and illegally accessed his phone records using pretexting. In June 2007, after a lengthy investigation by the US Securities and Exchange Commission, the SEC, it found that Allied broke securities laws relating to the accounting and valuation of illiquid securities it held. After the incident, Einhorn published a book, fooling some of the people all of the time, regarding this 6-year fight. In June 2007, Einhorn shorted Lehman Brothers stock, believing that Lehman had massive exposures to illiquid real estate investments that were improperly accounted for. He claimed that they were using dubious accounting practices in their financial filing, and he shared his thesis on Lehman in November 2007 at his Value Investing Conference. When Bear Stearns had to be bailed out by the Federal Reserve in March of 2008, Lehman was widely considered to be in a weak financial situation. In a speech at a conference in April, Einhorn announced his Lehman short position. In May, Lehman CFO Erin Callanan held a private teleconference with Einhorn and his staff, who hoped Callan would explain discrepancies they had uncovered since the firm's latest financial filing. Einhorn publicly characterized Callan's response on the call in a negative light, and Lehman stock fell sharply. Callan was hired a few weeks later when Lehman reported a $2.8 billion quarterly loss. Lehman would declare bankruptcy in September of 2008. Then on May the 26th of 2011, Einhorn called for Steve Ballmer, now the owner of the Los Angeles Clippers, the CEO of Microsoft at the time, to step down after Microsoft had been passed by Google and Apple in market value. In January 2012, Einhorn was in the news again. The UK Financial Services Authority fined Einhorn and Greenlight Capital $11.2 million for trading on inside information. The FSA claimed Einhorn obtained information on the Punch Taverns PLC equity fundraising by a broker representing the company prior to public knowledge of the event. Over the following 4 days, Einhorn sold more than 11 million shares, avoiding a 30% stock price collapse and subsequent loss of £6 million. Then, a year later, in February 2013, Einhorn filed a lawsuit against Apple in a Manhattan court in order to pressure the company to issue dividend-paying perpetual preferred stock as a means of distributing some of its $137 billion in cash to shareholders. Basically, he took Apple to court to try and force them to give him money. Later that month, Einhorn set what one Wall Street Journal headline called a legal precedent in corporate governance, when the court ruled in favor of Einhorn and determined that Apple's attempt to bundle a measure requiring a shareholder vote prior to issuing preferred shares with a large shareholder proposal impermissibly bundles separate matters for shareholder consideration. Then in 2020, things started to fall apart at the seams. A short position in Tesla was Greenlight Capital's biggest loser in 2020, according to the hedge fund's fourth quarter investor letter. Greenlight's portfolio was crushed by losses from its position betting against Tesla very publicly in 2020, which saw the EV maker soar 740% that year. As a result of the stock's boom, the hedge fund said it adjusted its position ahead of Tesla's inclusion into the S&P 500. Greenlight founder David Einhorn has had a long-time short wager against Tesla and is feuded with Elon Musk in 2019. But he's not the only Tesla short seller who had a difficult year that year. Jim Chanos said in December that his short position was extremely painful. He reduced the size of his bet against the EV maker's stock the following year. Greenlight's letter didn't hold back against his critique of the stock of Tesla. Greenlight says Tesla cars are not a fad, but owning the stock is a fad. The firm also tore into Tesla's valuation. Now, at the time that he tore into Tesla's valuation, Tesla's price to earnings ratio was 1,700. Now, today, it's at 160. In other words, it's come down by a factor of 10x. And still, Einhorn still believes it's a good idea to short the stock, even though he lost literally billions of dollars doing so in 2020. Einhorn has just bought 1,000 put contracts against 100,000 Tesla shares in the fourth quarter of 2021, according to a new filing with the Securities and Exchange Commission. The shares are notionally worth $106 million. Einhorn's bet marks a renewal of his long-running bearishness on Tesla stock, which has, well, not worked out very well for him in the past, has it? In recent years, the famed hedge fund manager has moved in and out of positions against the company, leading to tensions with Elon Musk. Largely, a lot of the tensions have come from Einhorn very publicly criticizing Tesla, trying to use his public position in the media to influence the stock price, which will financially benefit him. I think this is illegal trading. I think this is an illegal manipulation of the stock price, but clearly the SEC doesn't agree with me. A put option gives the holder the right to sell a stock at a certain price in the future, allowing them to profit from a fall in the company's shares. But obviously those puts eventually will expire, and then the money is due, regardless of whether the share has gone up or down. The filing from Greenlight, published Monday, doesn't disclose the value of the bet. Now, this is what Elon Musk said to Einhorn back in 2020, after Einhorn very publicly criticized Tesla and he lost a lot of money. In fact, people believe billions of dollars on his shorting the stock. Elon tweeted, "I'm certain your investors would appreciate you getting smart on Tesla." Greenlight's new bet against Tesla was revealed in a 13F filing, a quarter report required of all investment managers with at least $100 million of assets. Now, this is what Brian Sozzi, financial analyst for Yahoo Finance, said in a discussion about David Einhorn's recent Tesla stock shorting.
Yeah, and one of the other 13F filing items, there's so many to sift through. We could just talk about it for the whole show. But one other one that caught my eye, David Einhorn over at Greenlight Capital. I admit, have not watched as closely recently, but a new short bet against Tesla. And he sort of has gone back and forth on Tesla over the past couple of years, but apparently he bought puts against 100,000 Tesla shares, according to that 13F filing. He has shorted Tesla in the past, most recently in 2020. That did not work out well at that time. And by the way, we don't know if he's closed out. To my point about this being a snapshot, we don't know if he's closed out this particular short position. If he has, he might very well have made money because Tesla shares have fallen thus far.
He has shorted Tesla in the past, most recently in 2020. That did not work out well at the time. I'll just quickly add, I think some of these short sellers that a lot of people fanboyed and fangirled over during the financial crisis, like David Einhorn, I'll toss Jim Chanos into the mix too as well. They've lost their luster. In large part because of the market's continued rise over the past decade. But certainly respect the research they put behind their calls. Now here is my thesis. Here's what I think is happening. When Einhorn shorted Tesla stock and said it was crazy, the price to earnings ratio was at 1,700, which is pretty big, right? Now it's down to 160. Clearly the valuation is much more reasonable today versus what it was then. Now, if we actually have a look at Tesla's forward price to earnings ratio, in other words, the predicted price to earnings that the stock will be at by the end of this year, that number actually comes down to 87.93. That puts Tesla much more fairly valued again. So what I don't understand is, if Tesla's stock price is now much more 10 times more fairly valued than what it was worth 2 years ago when he lost billions shorting the stock, why would it be a good idea to short it now when in only 12 months' time, their price to earnings ratio will be a very reasonable, for a tech company, 83? Doesn't make sense to me. Clearly, I'm missing something. Maybe Einhorn has stumbled onto some insider information that we're not aware of. I mean, let's have a look at the facts here. Let's have a think about this. Tesla is on track to increase deliveries this year by 50%. They have enormous queues for their cars. Demand is astronomical. Their costs to build their cars continue to decline as their manufacturing processes improve. And then there's the Hail Marys. The Hail Mary of the bot. The Hail Mary of autonomous driving. And then there's the energy. Who knows how that's going to pay off for the company? What I think is Einhorn has a personal vendetta against Tesla, against Elon Musk, and it's affecting his logical judgment. Now, if you're invested in Einhorn's fund, I suggest it could be time to move on and get out. Let me know in the comment section below what you think. Would you consider shorting Tesla stock now? Do you think that's a good idea? Let me know what you think. I'll see you again on the next video. Bye-bye.